Thank you very much, Christian. Good morning, everybody. So before I go into the deep dive of my presentation, I would like to share with you some key messages. First of all, and as you have heard from Oliver, we have delivered well. Maybe we could share also my presentation. I assume it's coming. So first of all, and you have heard it from Oliver, we are delivering well against the targets we had set for ourselves in 2021 for 2024. And obviously, the way the world has unfolded itself since 2021 is very different compared to what we were expecting back then. And you have heard that today. We have seen a war, we have seen massive inflation up, we have seen a bear market in the fixed income environment. And despite that, we are delivering well, which is demonstrating clearly the strength of our diversified business model and the resilience of our organization. Now, based on that strong starting point and also the secular trends you have heard from my colleagues and the levers we want to pull, we feel comfortable to raise our ambitions across the board. We are bringing up our EPS to 7 to 9% per year. We are also going to further focus on profitability under IFRS. We are bringing up our IFRS ROE to 17%. We are also focusing on profitability from a Solvency II perspective. And lastly, we are clearly an organization that is cash accretive, and we will continue that focus going forward. And we are targeting more than 27 billion of cash for this new cycle. Obviously, resilience is a very important dimension when it comes to the delivery of that performance, and I will also do a deep dive on resilience as part of that presentation. This plan we are committing to today is both, from my perspective, challenging for the organization and is at the same time well stress tested. This is a bottom-up plan, and just to give you a sense of what it means, just the last 2 weeks of November, Oliver and myself, we have been meeting with more than 33 top management team or board of management team of our operating entities to actually discuss and challenge their plan. And this is the outcome of that very rigorous process that we feel comfortable to present to you today. Let me now go into revisiting our accomplishment compared to our targets set for 2021. As you can see on this page, first of all, from an earnings perspective, we are actually delivering well. And basically, property and casualty has strongly beaten our expectations. Life and health has been doing a good performance. And on the asset management side, this is a miss, as you have heard, but this is coming from this bear market environment. When it comes to our delivery for 2024, we are very confident when it comes to those, as I have mentioned to you already during our third quarter close. Let me now go to cash and capital, as you can see on this page. And here as well, we have a good picture. Clearly, our organic own fund generation, our return on equity and our Solvency II ratio are a bit compared to our expectation. On the net cash remittance side, we are at 21 billion. This is due to the effect of structured alpha. And you know as well that with the Lucy transaction that Andreas has already mentioned, we were able to counteract on some of the effect of structured alpha. This is for me as well a good illustration of the fact that this organization is able to react also to unforeseen events very clearly. On the organic own fund generation, we are at 32 billion, so also ahead of our target. And this is linked to the very strong growth of our operating Solvency II earnings. On the net capital generation, this view is basically adjusted for the old dividend policy. So we are at 8.5 percentage point, which is below the 10 percentage point we had targeted. And this is due to the very strong growth we have seen on the P&C side. So this is also the reason why we see a better delivery when it comes to our organic own fund generation. So that's a good miss, if you want, in a way, clearly. But you will see later on in my presentation, this area is also a part where we want to focus on more as part of this new cycle. Then on the return on equity, this is clearly a bit, and this is as well a bit if you adjust for the move from IFRS 4 to IFRS 9/17. By the way, for those of you also doing the comparison, the change of accounting standards has really minor effect into the numbers I am sharing with you. So actually, nothing that I am sharing today is blurred by the accounting changes, neither from a past nor from a future perspective. When you go to Solvency II ratio, we are clearly ahead of our target with the strength of our capital base has strongly enhanced itself compared to 2021. And it's not only that we have more capital from a Solvency II perspective, but also the quality of our capital is very high. So now, clearly based on this strong starting point, the secular trends you have heard about today, and also all the levers we want to pull, and that you have heard from my colleagues, there is a lot of energy in the room very clearly. So we feel really strong that we can raise our targets across the board. So starting with EPS, we want to move our EPS target to 7 to 9 percentage point for 7 to 9% per year for this new cycle. Then we want to continue our focus on profitability, as I was mentioning, so from an IFRS perspective, but also from a Solvency II perspective. So bringing our ROE to above 17% for this cycle, our Solvency II ROE our Solvency II operating capital generation to 24 to 25 percentage points by 2027. And lastly, as we are growing our operating profit and as we continue our very strong focus on remittances, we want to bring our net cash remittances to above 27 billion over this new cycle. With this strong performance and also the strong resilience we have in the organization, and that you have heard as well from my colleagues, we feel extremely confident to reconfirm to you our attractive payout policy, which is made of two components. The first one is our 60% payout ratio with a ratchet upwards. That's basically unchanged compared to what we have shared with you together with our year-end results 2023. And today, we are formalizing an additional commitment, which was always there but has never been formalized, which is a minimum 15% additional capital return on average over the next 3 years. With the remaining maximum 25% of flexibility, we will be very disciplined. So that will be used for value-adding internal growth and as well for bolt-on M&As that will be mainly focused on adding scale or adding volume to our platform. Let me now unpack for you the development of our EPS for this upcoming cycle. So clearly, as you can very well see on this page, right, we see space for value creation in our three segments at this point in time. And this is very well displayed here. If you start with P&C, so on P&C, we'll be focusing on distribution, as you have heard from Klaus-Peter, so focusing on client acquisition, cross-sell, also higher retention. We'll also be focusing on technical excellence, which is very important, and as well on productivity. So that will allow us to grow the value we are creating on the retail side. You have also heard from Sirma all the great assets we are pulling together and on which we see a lot of opportunities for further development and for value creation that is coming into that number in addition. And on the commercial side, we take a cautious stand when it comes to the cycle development, but we are confident we can maintain the high level of margin we already have today in that business and continue growing, tapping into the areas where we have space for growth. On the life and health side, you have heard that from Andreas. We are planning to grow our CSM by 5% per year, and we will be as well growing in particular the capital lighter products, so our preferred line of business related to unit-linked and as well to health and protection by 7% on average. Moving to asset management, also, as you have heard from Andreas, we see opportunities in both AGI and PIMCO. Obviously, PIMCO, you know now all about it, as mentioned by Christian. So here we will be growing our asset under management, our third-party asset under management by 8% per year. And we will continue the very strong focus we have when it comes to efficiency to secure our market-leading positioning in terms of profitability. The last piece of our EPS development is actually coming from capital management, so that will be made of the 15% minimum additional return I have been mentioning to you, but as well value accretive capital deployment that we want to do, and clearly we also have really good targets in mind for this part too. So let's move now to cash and capital management. So clearly, capital and cash optimization is not new for the Allianz Group. We have been doing that for a very long period of time. But at the same time, we also see opportunities for doing better as part of this new cycle. And so I'm going to lead you through that as part of this presentation. As well, resilience is a fundamental part of optimizing both cash and capital, because obviously, in order to deliver on those dimensions, you need to secure that you are optimizing in terms of capital efficiency. So this is coming from the fact that you are looking at minimizing your volatility, and at the same time that you are securing that you are a good representation of your businesses under any type of solvency regime. So I will also spend time on this resilience dimension as I go through my presentation. Starting with economic value creation. So here, as a group, clearly we have always been spending time on optimizing both sides of the equation. So the earnings side and the capital consumption, very, very clearly tapping into the toolbox that is displayed on this page. At the same time, we also see more space for tapping into even more of those tools, which are related, as an example, to reinsurance or to alternative capital provider, as mentioned by Andreas today, like the Sconset transaction, but as well looking at our business setup or looking at the scope of our internal model together with the rest. So if I were to continue steady state as part of this plan, we'll be moving our Solvency II capital generation from 20 percentage point to 22 percentage point as we are growing faster our earnings compared to our capital consumption as part of this plan. But we see space in tapping into more of the into the levers which are also displayed on that slide. And as such, we are bringing our target to 24 to 25 percentage point for 2027 as an organization. Why do we see space for doing so is, from my perspective, really well illustrated on this page. First of all, you can see on the left-hand side that today, approximately 60% of our internal model covers our SCR. Clearly, we think that our internal model is a much better way to reflect the business we are operating into. And as such, we will be seeking to move part of our standard model business into the internal model, obviously in close alignment with our regulators. And on the right-hand side, you can also see that there is space for doing better under the matrix of Solvency II ROE as part of our portfolio. Obviously, we are managing portfolios, right? So we are not looking only at Solvency II ROE. We are looking at a comprehensive set of KPIs, including cash, including IFRS performance, and so on and so forth. But under that matrix, clearly you see that there is space for doing better. On the P&C side, we have businesses that are today either too capital consumptive, so this is also related to the model, as I was mentioning, or also to other reasons, and as well related to the earnings, earnings or scale. When you go to the life and health side, where we are operating at a 14% average Solvency II ROE, so slightly higher compared to the P&C Solvency II ROE, linked simply to the fact that this business is consuming more capital market type of capital. but still at a strong level of performance. We also have space for doing better, and we will achieve that by focusing on our preferred line of business, as mentioned by Andreas, and as well by doing more of the type of operations like the Sconset operation that we have been mentioning as well. Let me now move to cash. And here, so we have always been a strongly cash accretive organization. We'll continue our focus to have an 85% remittance ratio, which basically allows us to achieve an above 27 billion of net cash target for this new cycle. Obviously, also, the strong focus we are putting on operating capital generation will over time provide more leeway to create, will over time translate itself into cash and will provide more leeway structurally for us as well. Why should you have confidence into our cash remittances beyond the fact that I'm always asking for more cash in the board meetings, as my colleagues can confirm, is displayed on this page, I think. You can see on the left-hand side that our Treasury Department, together with our operating entity, is actually doing a very good job at securing a high diversified cash profile, both across segments and across geographies, across operating entities. Secondly, on the right-hand side of this slide, you can see as well that our cash remittances are made of two components, one which is recurring remittances, and the second one is excess cash. On average, our recurring remittances represent 90% of our remittances. This is a very strong base, clearly. As a CFO, I always like to look at also cash from a top-down perspective because I think it gives a good sense of what we are talking about. So on average, as part of this plan, we are expecting to get 11 billion of shareholder net income that is locally produced under local GAAP. Then post-remittance ratio and post-dividend payout, it means on average 2.75 billion of residual cash available to the organization. So over a 3 period of time, it represents 8 to 9 billion of residual cash in total. So out of that residual cash, we will be paying the minimum 15% additional capital return I have been mentioning. And for the rest, it will be used for further value-accretive capital deployment. Let's now move to resilience. As I have mentioned to you already, the resilience dimension is a very important aspect of the way we are doing our business within the Allianz Group, and is clearly a fundamental support to our capabilities to deliver the type of performance I have been mentioning, including the way we have been able to maneuver the last 3 years and delivering against our targets in that context. The way we are thinking about resilience within the Allianz Group is very holistic, and you can see that on this page. So we are thinking about resilience from an earning volatility, so this is really looking at the portfolio structure, the cycle, how the cycle is going to unfold. This is also thinking through in terms of macro sensitivities. We are also thinking about resilience in terms of risk management, obviously. So this is looking at our balance sheet, what are our tail exposures, what are the things we are accumulating on our balance sheet. This is doing this fundamental exercise of defining what are the right stress scenarios, so challenging ourselves, and then deciding if yes or no we like that risk, and if not, how can we mitigate it, and eventually can we go back at point of underwriting as an example. This is as well looking at the strength of our balance sheet, clearly from an asset, from a liability perspective, from a capital structure, and from a liquidity standpoint. And last but not least, this is as well from a governance perspective. So we are looking at governance, obviously, when it comes to meeting the regulatory requirements, from ensuring we have the highest standards when it comes to conduct, which is extremely important to us, also related to customer satisfaction, obviously. It's also, as a follow-up of structured alpha, we have been further looking at our governance oversight, and we have further strengthened our oversight structure. But it's as well, and for me that's a fundamental aspect, and I think for all of us in the board of management as well, this is in terms of risk culture. We are convinced that each and every of our employees are actually owning part of the organization, and each of them are basically in a unique situation to see something that nobody else can see in the organization. So we want to make sure that everybody feels very comfortable to speak up and to address the points that they are seeing. And as such, this is really connected to the diversity dimension we are striving for that Oliver has mentioned, because people feel comfortable to speak when they are in diverse environment. And the second dimension is that we want to make sure our people are very engaged also from that perspective. Let me now go into some highlights into our resilience profile. And I will start with the resilience on the P&C side in terms of earnings volatility. On the left-hand side of this slide, you can see our average combined ratio over the last 10 years and compare to the standard deviation of our combined ratio also over the last 10 years. And the gray dots actually represent peers. What you can see is that the Allianz Group has the lowest volatility of all peers when it comes to the P&C combined ratio. And we are performing at a high level of also performance when you look at the absolute value of that combined ratio. This is due to the very strong diversification of our portfolio, the high quality of this portfolio, obviously, across geographies, across line of business, and also the way we are doing technical excellence within the Allianz Group. On the right-hand side, you can see a summary of our reinsurance program, which is also playing a very important role in securing the lower level of volatility, obviously, against adverse events. I also would like to spend a bit of time on the cycle management, and here I'm picking the commercial business, obviously, because it's quite topical, as we see some of the softening already happening in the commercial business in some parts of the world. For us, when we are talking about commercial, it's actually made of the AGCS business, so the corporate and specialty business. It's made of the trade business, so the credit insurance, then the mid-corp business, which today is sitting into our operating entities. And then in the gray part, you will find the reinsurance business or part of the business operated as part of our platform, as an example related to partners. What you can clearly see on this page is that the way the cycle is behaving or the way the cycle is impacting those three businesses is quite different. So there is clearly a strong diversification effect between those three main pillars of our commercial and specialty business. And secondly, within each and every of those businesses, we also have a strong diversification under the shape or form of various line of business or various geographies. This is why, when you look at that picture, that we feel comfortable to have this view in our plan of maintaining a strong level of performance at basically the same level of margin for the next 3 years. Let me now move to macro sensitivities. So the purpose of this page is not to discuss what is the direction of rates for the next 3 years, which is, I think, vastly debated on average as a topic. And we don't take any strong position as part of our plan on what will be the direction of rates. The purpose of this page is to show to you how our operating profit will react to a relatively large shock when it comes to interest rates, so minus 100 bips, will basically translate itself into a reduction of our operating profit of 5%. Here you will see that within those, we have natural diversification that is coming from our segments. So obviously this shock would impact more our P&C business with an expected partial offset on the asset management side. But this minus 5% overall to our operating profit before any management action is, from my perspective, extremely manageable. Then if we move to our balance sheet and we look at P&C reserve first. Here you can see that over the last 20 years, we have delivered a positive runoff of above 3 percentage points. And this despite some challenging situations we have seen during that period. This is clearly the proof point of the strong way we are operating when it comes to reserving standards within the Allianz Group. We are also, in addition to that one, holding excess inflation buffers that we have put in place together with the spike of inflation. And lastly, when it comes to the most disputed part of our reserve environment, overall, like meaning the US long tail line of business, we have a minor exposure to it overall of 3% of our total reserves. And you may remember as well that together with the divestment of our US mid-corp business, we have further reduced that exposure during the summer. Let me now move to the life side, on the liability side. And you have already heard that from Andreas. We are clearly focusing on high-quality new business, which is made of our preferred line of business. This business is actually triggering higher margin and is as well coming with lower sensitivities to financial markets. So it has also, in terms of risk-return profile, a much better profile compared to the traditional products. And you can see how nicely this high-quality new business has already been earning itself into our CSM on the right-hand side, because it represents already today 72% of our CSM. So as such, this is bringing a lot of stability as well to our life and health earnings, because it's very low sensitivity also for the future. And you can already see that today in the sensitivities we are publishing for our overall CSM today. Let me now move to the asset side. Clearly, and Oliver has already mentioned that today, we like the quality of our asset portfolio. We have been obviously managing assets for a very, very long period of time, and we also have a lot of dedicated capabilities that allows us to source the best possible assets. So both in terms of traded and non-traded, we have a very high quality of our portfolio. And we are also conservative when it comes to the valuation of our assets. So you may remember that at year-end 2023, we had asked, as an example, PwC to perform a very stringent deep dive into our alternative assets to really secure that we are valuing those assets the right way. Just to give you a sense as well, when it comes to our own real estate portfolio, we do have external appraisal of those assets twice per year. We also have rotating process on a quarterly basis for the rest of our real estate portfolio. When it comes to private equity, we also are following the best practice standards when it comes to the valuation of those assets. So we are extremely stringent when it comes to the valuation of those assets. The second dimension that is very important to have in mind when it comes to our asset portfolio is illustrated on the left-hand side of this slide, where you can see that 80% of our assets are actually covering our life and health business, which means that basically we hold them for a longer duration, and also we hold them for total return. So we hold them to maturity to create value. So that is giving us a lot of strength in terms of immunization to market movements, clearly. And secondly, if we were in the need to react to those, obviously we have a lot of future discretionary benefits that gives us flexibility. And secondly, we can also always adjust our crediting rates. If I move further into the non-traded environment, so looking at non-traded equity and non-traded debt, there you can see that we have a lot of diversification in those two sub-portfolios. We also have a lot of, I would say, fairly standard assets into those non-traded portfolios. So you can see infrastructure on the equity side, or you can also see the non-commercial mortgages on the debt side. And lastly, we have a lot of long-standing experience, clearly, and very many natural buffers then in the way we are looking at those portfolios. So as an example, on the private equity side, that we are almost operating for 30 years now, we have many old vintages in the private equity portfolio. And on the non-traded debt side, you can see as an example that we are operating with low loan-to-value, as an example in our real estate lending portfolio. So again, high quality and very strong resilience of our assets portfolio overall, as I have already mentioned to you at the beginning. Let's Move to our capital, and here you can see that today we are operating at a 209% Solvency II ratio, which is well ahead of our target Solvency II ratio of 180%. And then you can see that we have a very high quality in our own fund structure, because more than 80% of our own fund are made of unrestricted Tier 1. Secondly, we have a lot of leeway when it comes to the tiering structure of our own fund. We like our very healthy level of debt leverage today at 24%, and we will be aiming at maintaining similar level of leverage as we go as part of the plan, which basically will mean that we will have extra capacity to raise debt if required as part of this plan. On the liquidity side, we are also very rigorous, and we do hold at holding level liquidity buffer of 8 billion. This is obviously a buffer. This is not intended for capital deployment. We want to have that buffer in place in case the markets will close, or in case there will be an issue that will not allow refinancing on our side, but as well in case of unprecedented industry events. We are intending to pay our dividend, our share buyback, any type of returns, and our M&A out of our very strong ongoing cash remittance that we have, that I have already mentioned to you today. This page, I think, is a very good summary of the resilience of the organization overall. And here we are basically stress testing our solvency ratio against different type of scenarios. You can see that in none of those scenarios we are basically below our 180 solvency ratio, which I think is a very important situation to be into today, given how uncertain the world is currently. You can see that our sensitivity to quite a severe equity shock of minus 30% is basically of 14%, so we are emerging at 195% solvency ratio. This equity sensitivity has reduced itself quite significantly compared to 2021, and this is also an area where we will be willing to further reduce our sensitivity, and we are going to work on that as part of this cycle. You can also see that against a combined stress test, so everything coming together, so equity, interest rate, and credit spread, we are emerging at 185%, which is a much reduced level of sensitivity as well compared to 2021. It has reduced by 40% compared to 2021. And lastly, you can see as well that we have a relatively low sensitivity of our solvency ratio to a relatively high Nat Cat event. Let me summarize for all of you. So our upcoming cycle is about lifting ambitions. We want to bring up our EPS target to 7 to 9% per year. We will continue to focus on profitability, both under IFRS and under Solvency II. And as we are today, we'll continue our strong focus as well on cash. We are aiming at delivering more than 27 billion of net cash remittances as part of this cycle. To deliver that, we will be focusing on growth, as you have heard from all my colleagues. We will be as well focusing on productivity, so tapping into new technologies as an example to really tap into our cost base, as mentioned by the colleagues, and supporting the growth. And also will be looking at the productivity of our capital further, as I have been mentioning to you. Clearly, resilience is playing a key role to ensuring that we can deliver against that ambition, and is also very much coming from the strong diversification profile we have within our business. And also simply, I hope you have understood that when I was sharing our holistic perspective from the way we are looking at risk management simply all together. This plan, I believe, is both challenging for the organization and is at the same time well stress test. And I think it's very important to do that exercise when we are in the environment we are into. And lastly, as our management incentives are very much aligned with all of yours, I'm very much looking forward to sharing with you the outcome of this plan in 3 years from now. And with that, I hand over back to you, Andrew.